Professor from StockChartSense.com here, and today is April 10th, and boy, what a day in the market, huh? Quite interesting. Okay, well, let's just get into it right here and let's talk about this. I'm going to actually give you a little bit of information today. This video might be a little bit longer, but I think it's important for you to understand what I'm about to tell you, so I'm going to try to explain it the best that I can, and I'm going to take my time explaining it and maybe even repeat myself a few times just to make sure you understand, because this is a very important day. And here's the bottom line: the market changed. Now, it's been changing for the last few days, but today I would say we got an official change that we know for sure. And what do I mean by that? Well, simply put, get that out of there. Simply put, I mean, here's a break of the 50-day moving average. Guys, that hasn't happened since here. I mean, all along, this stock is, now, by the way, this is the Dow Jones, if you didn't know that. I mean, it's just been going up, 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 up. So, I mean, it hasn't broken the 50-day moving average. I mean, back in, right in December, right at the end of December, you know, that's when it broke. I mean, I don't even know if you can consider this breaking it, but back here's where it broke the 50-day moving average. So this is a pattern change. And you need to recognize that. When you have a pattern change like that, that tells you something. The other thing you need to consider here, got higher volume. You know, not only did it break the 50-day moving average, but it did it on higher volume. So that tells you this is the distribution day. That means, what does that mean? That means the big boys are selling here. You don't just have some minor profit taking going on. You got some guys really banging the market, really selling the market. Minor distribution day, or not even a distribution day, but profit taking, I mean, I would say would be this here. Notice how the stock kept going up. I know we're talking about the Jones, but I'm going to just say stock. You know, we had some of these down days, but you know, the market just kind of still went up. Those are just general profit taking days. But boy, when you get big day like this and the market is just really going down, and not only that, when you look at the broad market, the breadth of the market, and every sector has gone down, that tells you it's broad-based selling, and that usually means that it's under distribution. You know, I checked the market out, and the only thing that went up today was gold. That's it. Everything else was down. Everything was down. So this tells you something. So let's just look at a couple more things here too. Let's look at and by the other thing too, you got to look at here as well is you have the kind of not a volatility squeeze, a little bit, not much, but you know, the bands were kind of tight here, not as tight as here. But if you notice, what's going on is, you know, this band here is starting to point up, and this band here is starting to point down. That's just basically telling you that volatility is kicking in, and it's kicking into the downside. Well, we can see that in the price action as well as the volume. So there could be some more down days here. But I will tell you this, a couple things. One, because we've had these down days here, we've had what really, I guess we'll call that one 1, 2, 3, 4. Really, this is the 5th down day on increasing volume. We could see a bit of a bounce tomorrow. Because we've had just these down days here. We've had 5 down days, and Alcoa reported a pretty decent numbers according to headlines. I didn't check out the fundamental part of it, but according to headlines, they beat expectation. So I can see a bit of a bounce. But here's the deal. The question is, how far is this bounce going to go? I mean, is it going to come up to here and then start to work its way back down? Or is it going to come up to here and then start to meander around a little bit and then work its way up? Guys, that's a question yet to be answered. We don't know. Nobody knows. Here's the problem. Earnings is here. Earnings season is here. So if you think about it, you know, last earnings was in February. There it is. Boom. This market has rallied since then. Well, I think investors are fearful that this earnings season may be a little soft. So they're taking risk off the table. It would be a big difference if the market was down here. If the market had, you know, in this earnings season, let's say the market started to correct and actually came down, and then now it was starting to work its way up. But that's not the case. The market went up from last February, or from this February. during earnings season. It just kept going up. So it makes logical sense, if you think about it, for traders to take money off the table. Why? Because if there is any doubt at all that earnings just might be a little soft, they don't want a lot of risk on the table. They're going to take risk off. That makes sense. So you got to keep that in mind as well. So earnings is going to throw a curveball at us here, because guess what? If earnings actually turns out better than what traders are thinking, do you know what's going to probably happen? I mean, the market's probably going to start coming back up and working its way through all this resistance up here. Because, by the way, this is now resistance. What do I mean by that? Simply put, if you were a trader and you bought right here and the market is here now, are you happy? Are you a happy camper? And I'm sure most of you are saying no, unless you were short the market. Then you would say, yeah, I'm a happy camper. But if you bought up in here and the market's here, you're not happy right now. Why? Because you're losing money. You don't like to lose money, right? If you do, give it to me, because I like to take money. So if indeed traders bought here and the market's here, guess what's going to happen if the market starts to go up? There could be some selling kick in. These guys might start selling. Why? Because they want to get their money back. So you could see some hesitation if the market comes up here, and it could start to meander around a little bit and then maybe work its way up. But it's got some supply to chew through here. It's got some of these guys up here who's going to want to get out, because now they're afraid the market might be going into a correction. So keep that in mind as well. So if the market does bounce tomorrow, how far it goes up, I don't know. I mean, you'll know when I know. It could come up to here. You know, we could get up above 13,000, and then it might start working its way back down. But again, I think that's all going to be dependent on what the earnings are like. If earnings turn out to be better, it could get up to 13,000, meander around 13,000, and then start working its way up. That's a possibility too. So right now, the bottom line is simply this: we're in a wait and mode. We're in a wait and see mode. That's all there is to it. So let's look at a couple more things here, and then I'll tell you what you can be doing. Okay, this is the they call it the diamonds, which is basically it mirrors the Dow, but this is a tradable instrument, so you can actually trade this. You can't trade the Dow, but you can trade this. And what I want you to see here is this. Look at the high volume here. I mean, geez, it broke the 50-day moving average here, of course, because it mirrors the Dow, but you could really see the high volume here. And again, you could also see that volatility squeeze a little bit there, pushing to the downside. So depending on what earnings are going to do, we'll see what happens. And the same dynamics here. We're at a 50-day moving average. You know, it broke here, and then from there on out, it was running up, and so this is a new pattern. But here's the spiders, which is it actually mirrors the S&P 500, and again, same thing. I mean, you can see the high volume, and it's just starting to break the 50-day moving average. So really hasn't broken yet. So actually, this here is I really like this better than the Dow, because this is made up of 500 stocks. So it hasn't totally broke the 50-day moving average yet. So it's actually just pulling back to there. But again, remember, it hasn't done that really since till back here. I mean, it's really when it last did that. So all along through here, it just, you know, really never pulled back to the 50-day moving average. So the bottom line, again, the market has changed. The conditions have changed. You just need to be aware of that. I wrote a little blog today on my website that states that you know, when the market changes, so does the trader, or something like that. But here's the bottom line. You know, when you notice the market is changing like this, you need to change. You need to be flexible and willing to change. And what do I mean? Well, you need to go through your stocks and say, okay, do I have profit? Yes, I have profit. You know what? If we get any strength tomorrow, it might be a good idea to take some profits off the table. Earnings is coming up. Know when your earnings are for your particular company, and you know, and then you have to make a decision. Do I hold my company or my stock over earnings season? But you need to have a plan in place. So if you have some profits, I would highly advise, especially tomorrow, if we get a bounce. I'm suspecting tomorrow we're probably going to get a bounce, maybe even a decent bounce. If not tomorrow, I would think at some point this week, because you got Google reporting on Thursday, and I think that's going to even maybe help push the market. So again, I could see a bounce happening tomorrow, but we'll know for sure tomorrow, won't we? But you know, if you get a bounce and you have some money on the table and some profits, take a look at maybe taking some off the table. And by the way, I'm talking about trading here. I'm not talking about investing. So whatever you hear me say, make sure you apply that to trading and not your investing account, because trading and investing are two different things, and you need to understand that, because you'll be hearing me talk and you go, oh, I should be selling this or I should be doing this in your investing account. No, that's something different. I'm talking about trading. So you need to apply it to trading, not investing. If you want to learn more about what's the difference between trading and investing, go over to stockchartsense.com and sign up for the premium content, and you can watch my tutorials, and I actually talk about that. I actually tell you how to invest and how to even buy a stock, as you invest, and then how to buy a stock if you're trading. I tell you the difference and the risk management of each, because there's different risk management. For investing, you have to follow these set of rules, and for trading, you have to follow these set of rules, and they are totally separate. So again, I'm talking trading here, not investing, so keep that in mind. So go through your stocks and check them out. Let's look at Amazon here. Again, if you bought Amazon right here at 200 bucks, did you have a plan? Did you have a plan that if the stock went down, what were you going to do? Or were you buying it here planning for it to go up? You must always plan for the downside. It's great to have a target price. Like I can say, oh, 220 is my target price and I'm going to get out when I'm buying right here. Here's the problem though, guys. What happens if the stock goes down like it did? What was your plan for that? See, I had made a plan. I'm going to tell you actually what my plan was. I had bought a little bit right here. My plan was this. I was going to go, I thought, okay, we're good here. My plan was though, you know what? I'll give this thing down to 190 because I think it could pull back to 190. So I bought a little bit in anticipation that it was going to come down to 190. And my goal was, and my plan was that if it came to 190 and really held there, I was going to buy some more. And then I was going to ride it up. Okay, if it held. Well, it didn't. It broke through 190, which also means it broke through the 50-day moving average. Now, in light of the overall market, now the volume wasn't super heavy, but nevertheless, in light of the overall market, and it broke where I had drawn the line in the sand. This was my line in the sand, 190, right? When it broke that, guess what I did? I was out, because that was my plan, and I traded my plan. You must have a plan. The other stock I talked about that you need to was Google. I talked about Google yesterday. Now Google actually did pretty good today. Why? It held the 50-day moving average. And the volume wasn't terrible, but it held that 50-day moving average. Everything else seemed to be breaking the 50-day moving average, and it was holding. One reason I think is because because earnings is on Thursday. I think people are buying into this in anticipation the stock is going to rally up before earnings, and then I think you might get some selling. Or it could keep going up. Who knows? I mean, with earnings, you just don't know. It's tough to trade earnings. But the bottom line is this. If you bought Google here, did you plan for the downside? Or are you just piling in here and thinking, oh, I'm going to make a boatload of money because it's going to 650, I know it. What happens if it breaks the 50-day moving average and starts trickling down? What was your plan? I'll tell you exactly what my plan was. Right here, baby. If it falls below that point, I'm out. Why? Because it's breaking the 50-day moving average, and my thesis yesterday was it pulled back to the 50-day moving average, which is about the breakout point for this volatility squeeze. If it falls below that point, in my estimation, in light of the overall market, the thing could have further downside. Okay? So you must have a plan. Sometimes your plan is this. Buy a little here and then say, well, if this thing actually does pull back some, maybe down to 600 bucks, if it gets to 600 bucks, then I'll go ahead and buy a little bit more here. Because my plan was to buy a little here and buy a little bit more down here at $600 if the stock sold off. That wasn't my plan. That was not part of my thesis. So you need to make sure you plan your trades, and then you need to execute that plan. If you don't, you're going to get your hand headed to you on not such a silver platter. I'm telling you, you'll get killed because you'll be buying so much stock here thinking it's going up here, and you're going to make this boatload of money, and then it starts to shoot down here and you don't know what to do. And now you're like a deer in the headlights because you're afraid to take the loss because you piled in so much. You have so much stock on invested in this, you're scared to death now, and you're like, dude, I can't take a loss, clear down here. I'm going to lose my shirt. Well, you know what? But the problem is, what happens if it keeps going down here? Again, in light of the overall market, you don't know what's going to happen. You must always plan for the downside. If you don't, you're going to get killed. I'm telling you, you're going to get killed. And if you're a long-term investor, guess what? You always plan for the downside. If you plan for the downside, the upside will take care of itself. The price target that you think, like 675 or 650, whatever you think your price target is, that will begin to take care of itself. But you got to plan for these down days. Today, a lot of investors probably got caught with their pants down. They had too much risk on, and the market started going down, so they started banging the table and selling. Well, guess what? Tomorrow you might get a nice up day. If you were already making plans for the downside, you wouldn't be getting killed. And guess what? When you do that, you can look at this market in a different perspective. You can look at it with the big picture versus looking at it through the eyes of fear. You can look through the eyes of opportunity, or you can look through the eyes of, I probably need to sell this here because it's going against my plan. Because what happens is when you're caught with your pants down, fear kicks in. When fear kicks in, guess what happens? You do dumb things. You make decisions based on fear and not based on, good common sense and good logical sense. It's all based on fear. And matter of fact, that's what you saw today. If you think about it, the market at the end of the day, look at this. The market ended at the low. So guess what? Every time there an intraday, and I'm not going to take you to the intraday chart, but go check it out. Anytime there was a little bit of an uptick, just a little bit, boom, people sold into it. Guys, that's even different, because back here, every time the market came down, like here, every time the market came down, people bought into it. That's different. Every time the market came down here, people were selling it. Nobody was buying into it. Matter of fact, it's just the opposite. Every time it came up just a teeny tiny bit, everybody was banging it and selling it down. So that's even different. When you have people selling the market as they were today, that's telling you things have changed. So keep that in mind, and be careful out there, and watch what happens. And we just got to kind of see what happens through earnings now. So just be careful right now. Just be careful. That's all I'm saying. Doesn't mean there won't be opportunities and maybe some trades you can make, but you need to be careful and watch yourself, because the pattern has changed, and when the pattern changes, the trader changes, and that's all there is to it. And I can hear some of you say, well, yeah, the other day you were saying buy Amazon. Yeah, I was. You're exactly right. And at that point it was a great buy. But guess what happened? We had a downgrade, and then the market's starting to get a little crappy. So you have to learn how to change, because things happen. That's why I tell you, plan for the downside. Because why? Things happen and things change. You always have to plan on being wrong. If you don't plan on being wrong and you think, well, I'm right, I know I'm right, I'm telling you, you're going to get killed. You're going to kill yourself. Plan to be wrong. If you plan to be wrong, then guess what? When you're right, you're going to be real happy. But if you are wrong, you're going to be real happy, because you plan for being wrong. Obviously, if you buy something, you think it's going up, right? But you got to plan that, you could be wrong. And what do you do if you're wrong? That's the key. All right, listen, I think that's enough. I probably hammered you guys to death here, but I think it was important to go into that much detail and to really explain this out, because things have changed in the market. The tide has changed, and you just need to be aware of that. So we'll see tomorrow if we get a bounce, since Alcoa reported decent earnings. Listen, head over to stockchartsense.com and sign up for the free video, and I'll send you a personalized little email with your name and everything saying, hey, I posted a video. Wouldn't you like to receive that from me? Listen, I love the receipt. I signed up myself. I really did. I signed up myself, so that way I can receive an email from me. That's how much I love it. So go over and do the same. Talk to you later.